Hello and welcome. My name is Simon French and I'm Chief Economist at Panmure Gordon. Today we're going to take a look at how the current global outbreak of COVID-19 is impacting on monetary policy around the world. Back in 2008-9, at the height of the financial crisis, in the first quarter of 2009, about 70% of the global central banks were easing monetary policy, i.e. cutting interest rates or adding to their asset base in any given month. That has been superseded in the current month, for March 2020. You've actually seen almost 80% of central banks easing monetary policy to try and deal with the economic disruption of COVID-19. That is extraordinary in itself. What has been more extraordinary has been the level of asset purchases committed to by all central banks as an anticipation of the amount of public spending that is going to be necessary to compensate employers and employees because of social distancing that is taking place because of COVID-19. Now, for investors trying to look at the fixed income market in an environment where the Federal Reserve, Bank of Japan, the ECB, the Bank of England are all buying assets, makes it very difficult to know how to navigate that marketplace. On the one hand, printing money should be inflationary, supply disruption should be inflationary, but on the flip side, big collapse in demand because people can't go about their daily life is deflationary. Added to that, central banks are seemingly prepared to buy up all of the additional issuance that governments are planning to compensate employees and employers, pushing yields down. Now that, from an economic standpoint, is entirely plausible. Indeed, it's entirely sensible. The government and the central bank should act as insurers of last resort. But for investors who are looking at fixed income and thinking about potential for either capital losses if yields go higher, or looking for alternatives in terms of capital preservation at a time when big economic disruption to corporates and risky assets, then it's a very, very uncertain market. So we continue, to conclude, to look at how central banks will manage their communications going forward to try and make it clear to investors that they're going to continue purchases as long as is necessary to maintain stability and investment intentions in the real economy. But on the flip side, also making it clear that there is a healthy private market for fixed income, government assets and debt going forward. And central bankers, Christine Lagarde in the Eurozone, Jay Powell in the US, incoming Governor Andrew Bailey in the UK, are going to have a really difficult communications challenge because investors went into 2020 anticipating there will be much less central bank action this year, and what we're seeing is unprecedented central bank movements at a level we haven't seen ever before in this cycle.